In this video, we're going to take a look at something called a divergence. It means that price action and momentum have diverged. This is normally done using an oscillator, such as the moving average convergence divergence indicator or the relative strength index indicator. Essentially, what you're looking for is price to do one thing while the momentum indicator does the exact opposite. So, for example, you may have a situation where the RSI starts falling, the relative strength index indicator that is, while price continues to rise. That shows that you are perhaps running out of momentum. That is a sign that maybe the market is getting ready to turn. A divergence trade is simply looking for the market to be saying one thing, but perhaps doing something differently under the surface. So by all means, this is a great addition to any candlestick patterns that you trade, or just simple 1, 2, 3 patterns, zigzags, whatever. So in this video, I'll run through a couple of examples and show you just how the divergence trade or the divergence setup can give you a little bit of a heads up as to the fact that the market might be getting ready to change a bit. Okay, so what I will do is I will pull up a price chart and show you an example of potential divergence. So you'll need an oscillator. Let's go ahead and put the relative strength index on the chart. And you'll notice that the relative strength index typically moves with price overall. Not always, but for the most part, it does. So with that, you expect, in this case, the Australian dollar falling brings the RSI quite a bit lower. But notice over here, during the month of November in 2023, the price action in the Australian dollar spiked quite aggressively. But at the same time, the highs were equal. So you would expect at the very highs, the RSI to be stronger than it was. And it really wasn't. As an illustration, you can take a trend line and just look at it. You put a trend line here just to show the price action. And you can see just how divergent we had been. In this case, we had a shooting star candlestick at a large round number in the form of 0.69, which historically speaking has been an area of interest in the Australian dollar. So once you saw this, you had a couple of choices. You could have either shorted the Aussie dollar, or if you were already in the position, you may have begun to take a little bit of profit, maybe even move your stop loss up. It's probably worth noting that divergence works on all time frames. So I can look at this on a shorter time frame and find examples of this as well. Here's an example on July 11. The market had shot straight up in the air and then started to rise again on the hourly chart. Notice how the trend line that you would draw on the RSI was negative while price was rising. That's a sign that perhaps you're running into a little bit of trouble. I'd point out that you formed a little bit of a double top and then broke down from there. You had run out of trending strength, as it were. Let's go ahead and open up another chart. In this case, I will do the dollar against the Swiss franc. And you can see that this has been a very choppy pair over the last couple of years. In this case, I'll put the moving average convergence divergence indicator at the bottom. And typically for a divergence trade, we pay attention to the histogram. So notice that the histogram is rising while price and the US dollar against the Swiss franc is falling. This is a sign that perhaps something's about to happen. Perhaps you're running out of momentum to the downside. So at this point, your instinct should be, is something about to happen? Do I see a momentum shift? And when I see that momentum shift, how do I tackle it? There are a lot of different ways to do it, and depending on your system, it can vary greatly. Notice this is on the daily chart, but when I do it on the 1 hour chart, perhaps it's a little bit different. And it in fact is. So as a general rule, what you're looking for is divergence on a higher time frame and taking advantage of it on a shorter time frame. So for example, in this case, we have a beautiful shooting star that has sent the market right back down from the 0.8820 level. I suspect that if we break that little bit of resistance, maybe even this little ledge here just above there, it's likely that the momentum will carry the US dollar higher. That little bit of divergence has you thinking what could happen. Divergence is not something you trade immediately. It tells you that there might be a setup there, and that's what makes it so powerful. Let me go ahead and pull up another chart. In this case, I will pull up the British pound against the US dollar. Let me put on the moving average convergence divergence indicator. And notice that in this case, we have rallied pretty significantly. We pulled back, but the momentum is still positive. So this is not divergence. And this is one thing that you can take off of your list of concerns. In this environment, maybe you look to the Fibonacci retracement levels. In this case, you can say, hey, we're at the 38.2% Fibonacci retracement level. We don't have divergence, so the momentum is still overall working for us. Therefore, you can be a little bit more confident, perhaps, of taking a trade, breaking above the top of the hammer. This is a trade that has no divergence in it, so that does help you. Again, though, this does happen on shorter time frames as well. So here's a perfect example here. You may have looked at the British pound on the 15-minute chart and noticed that we had an ascending triangle, but at the same time, notice that the momentum was sloping lower. That is a bearish sign, and that's exactly what happened. So there are other indicators that you can use for divergence, but by far the moving average convergence divergence indicator and the relative strength index are your two go-tos.